Welcome to the China Memo, where Chinese reality meets the Western point of view. I'm your host, born in China, trained in Western finance. We go to the source, no hype, just signal. Here is a number I want you to sit with. 80 million. That's the estimated number of homes sitting empty or unsold across China right now. Not under construction, not in planning, empty, finished or nearly finished, and going nowhere. To put that in human terms, that is enough vacant housing to shelter the entire population of Germany. This is the year 5 of the bust, and the question is no longer when does housing recover. That question has been quietly retired. The question now, the one that actually matters for anyone tracking global demand, trade flows, and where Chinese capital goes next, is what replaces it. Today, I want to give you 3 things. 7 core facts about how deep this crisis actually runs. The channels through which it is reshaping the broader economy, right now. And 3 frameworks for thinking about what this means, not just today, but for years to come. Let's begin. First, the basic picture. And I want to be precise here, because the scale of this is easy to underestimate. China's real estate downturn is now in its 5th consecutive year. Sales, price, new construction starts, completions, all still falling, with no clear inflection point in sight. More than 60 of the country's largest private developers have either defaulted on offshore bonds, that's debt sold to international investors, or entered restructuring negotiations. Even China Vanke, one of the largest state-backed firms, has been fighting to avoid a similar fate. Now, here is why this is structural, not cyclical. Beijing has said so itself. Officials have explicitly stated that the old model, what they describe internally as high debt, high leverage, high turnover, has in their own words reached its end. The housing minister has written that the future of the industry will be characterized by affordable housing and basically stable prices. In other words, the government is not promising a recovery. It is managing a controlled retreat. And the numbers confirm it. Housing investment has fallen from a peak of 12.3% of GDP in 2020 to just 6.1% in 2025. Think of GDP, gross domestic product, as the total value of everything an economy produces in a year. When housing goes from representing 1/8 of that total to 1/16 in 5 years, you feel it everywhere. Completions are nearly 40% below 2021 levels, and the China Index Academy, one of the most closely watched property research firms inside China, forecasts further declines of 6 to 11% across key metrics in 2026 alone. This is not a dip. One prominent Chinese economist estimates that as many as 80% of developers and construction firms could ultimately exit the market as the industry permanently contracts. That is a sector in structural decline, not cyclical recovery. Now, let's quantify what this means for the broader economy. Real estate and everything it touches, construction, raw materials, furniture, home renovation, financial services, used to represent roughly 1/4 to 1/3 of China's GDP when measured broadly. Goldman Sachs estimates that the downturn shaved approximately 2 full percentage points of China's annual real GDP growth in both 2024 and 2025. 2 percentage points sounds abstract. Here's a way to feel it. Think of the Chinese economy as a train. For 2 decades, real estate was the engine, pulling everything else: steel mills, cement plants, glass manufacturers, interior design firms, mortgage lenders. When that engine starts running in reverse, everything attached to it slows down. The sectors being positioned to absorb that displaced demand: exports, advanced manufacturing, AI infrastructure, are growing fast, but they are not yet large enough to fully compensate, not even close. That drag is expected to narrow as the sector's share of the economy mechanically shrinks, but it remains a meaningful headwind for the foreseeable future. And that matters not just for China's growth rate, but for everyone who sells into China or competes against Chinese exports. Next, local governments and the financial system. Because the property bust doesn't stop at the household balance sheet. Here's the context. For decades, local governments in China funded themselves primarily by selling land to developers. Schools, hospitals, roads, public services, all financed in large part through land sales revenue. National land sales revenue has collapsed from 8.7 trillion yuan in 2021 to 4.9 trillion in 2024. That's a drop in nearly half in 3 years. In other words, the fiscal model that funded local services across the entire country has broken down. These governments are now carrying trillions of yuan in debt, much of it through off-balance sheet vehicles called LGFVs, local government financing vehicles. Think of them as shadow balance sheets, entities set up specifically to borrow money that wouldn't show up directly on government's official accounts. The liabilities are real, the transparency is not. Now, here is where it connects to the banking system. Researchers at the Dallas Federal Reserve recently estimated that, in 2024, roughly 40% of bank loans to the real estate sector were to companies whose operating earnings could not cover their interest payments, up from just 6% in 2018. Most of those loans are being rolled over rather than recognized as losses. It means that the banks are extending new loans to pay off old ones, keep technically insolvent borrowers alive. These are called zombie companies, firms that cannot repay their debts but are not allowed to fail neither. However, I want to be careful here. This is not a prediction of a financial crisis. China's mortgage underwriting has always been conservative. Minimum down payments of 20 to 30% provide a substantial equity buffer, and the mortgage non-performing loan ratios remain below 1% at major banks. The concern is concentrated in regional banks and smaller rural institutions with heavy LGFV exposure. But the IMF itself has flagged that its systemic analysis of small bank risk is, in their words, hampered by lack of publicly available data, and that authorities declined to share institution-specific exposures. In any financial system, opacity is itself a risk factor. What you can't measure, you can't manage. Here is where the property story becomes a global story. And this is the part I'd encourage you to sit with if you're tracking trade policy or supply chain in any manufacturing sector. As private investment contracts, primarily because of the property slump, China's economy has leaned more heavily on manufacturing and exports to sustain its growth rate. Factories that once supplied the domestic construction boom are now redirecting output offshore. Export prices have fallen. The currency, according to the IMF, is undervalued. and China's trade surplus, the gap between what it exports and what it imports has reached record levels. Now, here is why this is structurally significant. Tianli Huang at the Peterson Institute, one of the leading economics think tanks in Washington, puts it plainly. The housing crisis is a major driver of China's growing external imbalance. Household investment, largely housing purchases, has collapsed. Household savings have risen sharply. That shift has pushed up China's overall saving investment gap. In other words, China is producing far more than it is consuming domestically, and exporting the difference to the rest of the world. Some economists are calling this a second China shock. Think of the first China shock as the early 2000s, when China's entry into global trade disrupted manufacturing employment across the West. What's being described now is a second wave, not driven by new entrants, but by a domestic demand vacuum pushing even greater volumes of industrial output onto global markets. The IMF is direct about the risk. Continued reliance on export is, in their words, less viable for sustaining robust growth going forward. The world's trading partners are not passive recipients of that surplus. Now, a word on policy, because this is where the gap between what's needed and what's being done becomes most visible. Beijing's stated goal is to stabilize the property sector and manage its transition to a smaller, more sustainable size, not to restore the previous boom. The government has eased mortgage requirements, lowered interest rates, relaxed purchase restrictions in many cities, and launched what is called a whitelist mechanism, directing bank lending towards completing unfinished housing projects rather than bailing out the developers who built them. The distinction matters. Completing homes restores trust with households. Bailing out developers rewards the same entities whose reckless leverage caused the crisis. Beijing seems to be trying to do the former without the latter. But the market response hasn't yet aligned with the policy ambition. Take the PBOCs, that's the People's Bank of China, special lending facility for purchasing unsold inventory. This was designed as a core pillar of the stabilization plan, yet currently only about 6% of that quota has actually been drawn. In other words, there's quite a gap between the policy intent and the market take-up. Local state-owned firms are looking at the math. The low rental yields versus the cost of managing these properties, and they are making a rational choice to wait. They see a potential mismatch between the price of the rescue and the value of the asset. And as long as that gap exists, the inventory remains stuck. The IMF's prescription is a heavy lift. It wants Beijing to spend several percent of GDP to finish homes, restructure developers, and build a social safety net. Essentially, they're asking Beijing to move the debt from the family to the state. But implementing that at scale would require recognizing losses explicitly, sharing the fiscal burden between central and local governments, and accepting slower progress on other strategic priorities. These are deeply political choices, and so far, Beijing has chosen gradualism. So, with all of that as context, let me give you 3 frameworks for the near-term outlook. Framework number 1, from property-led growth to an export-heavy imbalance model. If you zoom out, the pattern becomes clear. As the property sector permanently shrinks, China is filling the gap with manufacturing investment and exports. That's not a short-term stimulus story. It's a structural reallocation. For anyone managing global supply chains or competitive positioning, this implies a more persistent backdrop of overcapacity, downward price pressure, and policy-driven trade disputes. The question to keep asking, which sectors are being structurally favored by credit and policy allocation inside China, and which are being structurally derated? Framework number 2, a slow burn balance sheet adjustment, not a sharp crisis. The Dallas Fed's comparison to Japan's real estate-driven debt crisis of the 1990s is worth taking seriously. When there are few constraints on rolling over bad loans, that is, when banks extend new credit to keep insolvent borrowers alive rather than forcing defaults. The result is what economists call zombie lending. Capital gets trapped in unproductive firms. Productivity declines. Growth slows. Japan experienced this for more than a decade before it could fully restructure. China is not Japan. The political system is different. The tools available to the state are different, and the scale of the economy is different. But the underlying dynamic, losses that are real but not yet recognized, is analogous. The question is not whether those losses exist, it's where they ultimately land and over what time frame. The recommended path out of this crisis, central government fiscal support, explicit loss sharing between levels of government, stronger national safety nets, implies a fundamental shift in how China's economy is organized. What was once a decentralized land finance-driven growth model is being pulled toward a more state-directed, centrally allocated system. That's a slow-moving but consequential shift. Watch where capital, credit, and regulatory favor flow, because that tells you which sectors Beijing is willing to back with sovereign resources, and which it is willing to let contract. So let me leave you with this. China is not on the verge of a short-term housing rebound. It is in the middle of protracted, managed retreat from a model that once accounted for a quarter of GDP, that underpinned household wealth for hundreds of millions of families, that funded local government services across the country, and that kept the banking system's loan books growing for a generation. The knock-on effects for consumption, for fiscal capacity, for trade balances, and for how the world's second largest economy relates to global markets are still unfolding. The open question over the next decade is this: will the property bust force China into a more sustainable, consumption-driven equilibrium? Or would it lock the economy into a low-growth, export-heavy model that keeps global tensions elevated and industrial overcapacity as a permanent feature of the landscape? That is a question I'll keep returning to in future episodes. And if this one was useful, share with someone who is tracking these dynamics. This has been the China Memo. Thank you for listening. A quick note before I go. Nothing in this episode constitutes investment advice, a trade recommendation, or solicitation to buy or sell any security. The China Memo is produced for informational and educational purposes only. All views expressed are analytical observations based on publicly available information. Listeners should consult qualified professionals before making any financial decisions.